are talking about debt tonight. We're talking about leverage in multifamily acquisitions. So Lee, take it away. Introduce Green Force Capital.
Absolutely. Thank you. So Green Force Capital is the sponsor of this event. And what we really are is this is for Make It Happen Multifamily. So Make It Happen Multifamily is our education platform. It is how we spread the gospel of investing in commercial multifamily assets. In my opinion, the greatest asset class of all available to normal investors. At least we try to do our best to make it available to any normal investor in the marketplace. And that's what Green Force Capital does. So today we're here to discuss debt. Debt is a scary subject. Some people think that debt is extremely scary. They think of credit cards. They think of, dirty,
Bad
sleazy,
debt.
like used car salesmen, buy here, pay here lots, people getting taken advantage of. But if you utilize debt in the right way, it is a tool. It is a tool that can greatly assist you in amassing your an amazing investment portfolio. So who are we? We're Green Force Capital, and we are also the curators, my wife and I, Meagan Fjord, of the Make It Happen Multifamily Education Platform. We're a real estate investment firm that was established in 2019. We specialize in 506B and 506C syndications, currently have 50 million assets under management. And the education platform, Make It Happen Multifamily, is really focused on bringing you education opportunities and opportunities to network and connect with other investors trying to reach similar goals. All right, so today I'm really excited about introducing Adrian Hartman. Adrian Hartman is, in my personal opinion, the most intelligent debt broker in the marketplace that I've ever had an opportunity to do business with. I've done business with, I was a commercial broker with Marcus and Millichap. I've done business with a lot of people in the industry. Adrian is top level guy. Has helped us with a few of our transactions before. If you are interested in being an active investor like we are, as opposed to a passive investor, and you need debt, well, you should utilize debt. Make sure you take down Adrian's contact information. Make sure you reach out to Adrian, schedule a call to have that conversation ahead of time, because just like any other debt, you want to be prepared before you have the property. So I'm going to switch to the Adrian's set of slides and take it away, Adrian.
Adrian is also, real quick, Adrian is also a sponsor of the Make It Happen Multifamily Group. So we really appreciate his support in helping us grow and support the group.
Oh, yeah. Of course. I'm happy to have the opportunity, ever since meeting Lee years back and watching his growth and sort of, very systematic, very by the book. It's been an impressive journey to watch. You two come together. Honored every opportunity you guys give me to get in front of like-minded folks interested in the sector. I don't know many people that want to spend a bunch of time talking about debt. I spend all day, all night. Eat, sleep, and breathe it, right? So it's obviously something near and dear to me, something I'm passionate about. A bit about me as a person: born and raised in St. Louis. Hit my slide, if you will, Lee.
Ooh. There we go.
I'm born and raised in St. Louis, married for 10 years, have a 7-year-old daughter, a 5-year-old son. I love outdoor sports, hunting, fishing, boating, skiing, and sharing those activities with business friends as well. Only makes it better. I also am a real estate investor, so I have a majority of my net worth in real estate holdings. I've invested in multifamily senior housing, mobile home communities, self-storage, and I get to meet amazing people from my day job that give me opportunities to find quality investments to do just like what everybody here is trying to do: build a portfolio, have income, not be reliant upon a 9-to-5, right? I've been in this. Yeah, that's where we all want to get. So I've been doing this for about 17 years. I started out at a HUD only shop at the very bottom rung as a processor, getting promoted quickly to underwriting. That background has been so valuable. Understanding what goes into an application and why, where to find the answers, how to answer questions, and ultimately how to advocate for your client better. I don't need to go ask the credit officer. I can argue with the credit officer, right? So an underwriting background, tremendously valuable if you're going to be in the lending space. I think it's valuable if you're going to be in the investing space as well. But I've leaned on that heavy to build my production business. After my time at Love Funding, producing HUD-only debt, I took an opportunity to go to Prudential so I could learn more about agency solutions and life co debt, and was successful there. Built a fair sized office anchoring the Midwest for them before getting recruited to Colliers and heading up their Midwest debt platform. Here at Colliers, they've added a few more layers of creativity to the mix as of late. Debt funds and correspondent life co relationships beyond just the exposure I had of Prudential and perhaps maybe their conservative view. There are life companies out there who do all sorts of things, and having access to that's super valuable. Colliers Mortgage Holdings is our parent company, and they have a few subsidiaries underneath. Colliers Mortgage is what I'm a part of, focused on long-term fixed rate non-recourse debt, as well as just generally clearing the market for debt solutions. We have a related party called Colliers Funding, which I'll touch on here in a slide or two, that is essentially bank syndication. We are not a bank at all while being a direct lender, but Colliers Funding aggregates bank relationships to offer bank solutions to our client base. Many times deals can get so big, a single bank can't do it, but we will sell off those participating spots to our bank partners to offer those banks higher grade investment opportunities or higher grade lending opportunities, and then give our clients solutions. Colliers Securities is the arm which we trade the securities we create, the Ginnie Mae securities, the agency securities that we create through our securities platform that also handles bond issuances. And we also have an insurance brokerage division too, should folks get jammed up and need some additional support and service on the insurance side. Insurance is a kind of a painful topic these days, I think, for a lot. We're all kind of getting rocked on renewals and quotes. It's just been a lot of not fun on the insurance side, but I'm always willing to try to go find another option, either internally through my Colliers insurance arm or externally through relationships I maintain.
Yeah, I have to second that. Like Adrian has been super helpful with us. We've worked with him in the past and just come across problems that weren't even related to debt. And Adrian was able to always connect us with somebody in the industry or help us out with a little bit of knowledge himself. So super valuable guy to have on your team.
I view myself as as a partner to any one of my clients. I am very vested in the success of the clients, and I want their deals to be good ones, and I want to be able to work every angle I can think of. If it's recommending something as abstract as debt collection or something as straightforward as a management company, I try to find people that are of high integrity and very skilled at what they do, so that I can put them in my network and leverage that for my client base. Colliers Mortgage, Colliers Funding. I want to recap just sort of value and history here. We've been around for a long time. The mortgage licenses we own actually predate the 2007 quote here. That 15 billion in production, higher now, but is a good idea of what we've put out there. A high volume of business. We are licensed Fannie DUS lender and a licensed HUD lender as well. We are a direct lender, and we also service our own loans. We never sell off our servicing. Some people don't understand really what that means, so I'll clarify. Servicing is what happens after you close, and having a point of contact to go to, which you are assigned an asset manager at closing. I say, if you ever need anything, you call me. Just because I can short circuit layers and expedite things for whatever. If my person's not happy, it's my goal to get them happy and quickly, right? So
Adrian's made me happy before.
That's my job. That's my job, right? As quick as I can. I don't want to be frustrated over 60 minutes, right? Like, that's way too long for someone to be frustrated. But that's something that's a benefit to a lender who controls their own servicing. instead of smaller shops who might be able to create the paper, create the loan, but not actually provide service after the sale or retain their own servicing. So that's a big piece. I just want to point out that when working with any lender, ideally you're working directly with the lender, not through a broker. Nothing against brokers, but you can save a little cost coming direct and maybe have a more direct advocate. Additionally, that service after the sale can become quite important to you.
Right. And just to jump in, so Adrian, so if you're new to this whole space and have never dealt with commercial, financing or whichever, it's really similar to a residential situation where, you put your mortgage on your house and then next thing you know, you haven't even made your first mortgage payment and your loan's been sold off to another company. And now you don't know who your point of contact is. You've never talked to them before. And you hope they have a decent infrastructure where, it's so important whenever you're actually implementing a business plan and a business strategy that is heavily revolved around the type of debt that you have. Maybe you have a refinance or adding a supplemental, which we'll talk about what those things are. And it's really nice to have the same person who understands the business plan with you the whole time. So.
Absolutely.
All right.
Here I'm trying to highlight for you guys a little bit more. Like I mentioned earlier, Collier's funding. Collier's funding to me is intended to be a short-term debt option that we can offer to our clients as loans get large or loans get tricky. It may not be that preferred in these times as banks go wide on prices. You guys all probably have talked to your bankers lately and know that the prices aren't screaming borrow money these days, and a lot of lenders are acting like they want to lend and not. The agency side of things, the HUD side of things, we always want to lend. We want to lend if we can qualify, but that Collier's funding bucket can create short-term options for our clients to build or develop, acquire, improve, and then we have the agency or HUD takeout there ready. And so that relationship serves us well, just as an additional option in-house. Also, we're fully focused on being a comprehensive solution. So what I mean by that is we want to be a single point of contact to clear the market for you, so that even if you told me you wanted a Fannie 5-year, I still am going to line up all the options so that when you make that decision that you made the best decision. And if I disagree for some reason, I'd certainly point out, I see this as a recommendation based upon what you said. That said, I mean, borrower drives the bus in terms of what they want, but I like to make sure that if you're going into something that's long-term fixed rate, you're doing this with your eyes wide open and aware of everything and what options you could have. So we strive to clear the market and make people aware of their options. While my focus is multifamily and senior housing, along with some student mix, at Colliers, we actually execute across all income producing asset sectors. And so I have focused teams, on hospitality, for example, when a multifamily client might have a hotel deal, we still have options, again, striving to be that one-stop shop. So if somebody says, I'm trading this Phoenix, mobile home community, we might have something for that. So, just trying to show the breadth of experience that we have. And we are a national lender. A lot of folks here, St. Louis, they think, oh, you just do deals in Missouri. Not at all. I've closed loans from Alaska to Puerto Rico. We have a national reach, as our programs have a national reach. And we have offices and points of contact in terms of underwriting and market experts that we can leverage within our company, including appraisal resources if I need to call and get additional info, quick market updates. Having the power of the platform behind me as a lender is super helpful in being a good advocate to my borrowers.
It's fantastic. Adrian, we're seeing a lot of really big numbers. It's an established company who did 15 billion since 2007. What's the minimum sized loan? I mean, we see big numbers like 15 billion. When should someone call you when they're, what size loan and what size property are you loaning on at the minimum size?
We have options for all loan amounts in excess of $1 million. So, I don't like folks to get scared off when they think oh, that's a $20 million closing. If you watch my LinkedIn, I'll post a $2 million closing. So I know that I can help somebody grow from the entry level, or even there are large ownership groups that might take down a $2 million opportunistic deal, even if it doesn't really fit with their 20+ million investment strategy, just because, hey, they're going to make that money, right? So I support the clients making money every way they can, and we have different options for different tranches or loan sizes. But good question.
Yeah, our audience is people of every level, whether they're, somebody who has an established portfolio or someone who's just getting started, active or passive, and knowing when they should pick up the phone, when they're starting to look at acquiring assets that are over $1 million. That's when you really want to pick up the phone and start reaching out and having conversations with Adrian.
Back to your point about when to connect, though, Lee. You said it early on, and I don't think you can overemphasize the point of building relationships before you need relationships. That rings true with lenders, to get familiar, to understand what you're looking at, to help you with pre-qual letters if you're submitting a bid, right? That's a thing for helping sort of shine your presentation so that you put your best foot forward. And as we get into this basic slide, which covers, I'll say, lingo that's common to me, every minute of the day, but might not be common to others. I do want to point out sort of the basics that investors should prepare for before diving into the journey, right? It may be or may not be surprising, but a lot of people don't even have a PFS yet ready and available. To me, if you're playing at this level, you're looking to.
Let me just quickly interrupt you. What is a PFS? What does PFS stand
Some
for?
people don't even
Adrian?
know what a PFS is.
For those in our audience, think wide. Who those in our audience may not know. What is a PFS?
Yeah, so I meant personal financial statement. Again, sorry, it's just abbreviations all day long, right?
That's what we're here for.
Yeah, that's how it works. So personal financial statement is an outline of your overall assets that you control. It also takes into account certain things like income, and it's not just real estate. It's holdings of stocks and bonds and it's an entire picture of your personal financial position. Correct? Would that be kind of your general description?
Yeah, assets and liabilities.
Assets and liabilities.
Ultimately, what lenders or anybody making a credit decision is looking for is what is the net worth and what is the liquidity. That's what it's coming down to. But it's made up of those assets, liabilities, income, and also within that we see your REO, real estate owned. That's a schedule of your assets, your respective share in that asset, showing us how you participate and your level of responsibility there, be it GP or LP. LP obviously far less exposure than GP, but it gives us an idea of the investment ownership and management experience of an individual by looking at your REO. And the third piece of that puzzle, because REO is somewhat related to PFS, the two should tie. That's important. One matches the other, but your resume, and it's not like you're applying for a job. While understanding your background, educational background, all of that's important. What we're looking at is and trying to extract is understanding real estate deals you participated in at what level. Have you purchased five duplexes before, or have you purchased 5 40-unit projects? Because those are two different qualifying levels, right? If you're going to buy a 250-unit deal and you've only owned 5 duplexes and you're by yourself, no partners, the answer is no, right? So unless the one exception can be in the case of extraordinary net worth and liquidity, right?
Or you call Adrian and he introduces you to your new best friend and partner, Lee, and we can do the deal together.
Well, and just that's true. Actually, I'm constantly matchmaking amongst my client base when I can find commonalities, and it's like, we're doing this here and he's doing that there. Why don't you guys work? Have a coffee. See what you think. If you vibe, you vibe, and make a connection, right?
Oh yeah.
Bringing people together to do bigger and better things. In the end of the day, that's what it's all about.
Sure.
So some basics that I want to cover here. LTV, folks should be familiar with loan to value. In normal conditions, you're at 75+% LTV, not to exceed 80. That's been an expectation before. I think current conditions have tapered or tempered people's expectation. Right today, it's hard to pencil above 70. 65 to 70% is common. Right, so understanding your loan in relation to your value can be a lending constraint. However, it's typically in this environment of rising interest rates, most folks are DCR or debt coverage constrained, as most lenders look for a cushion beyond your NOI that covers, after you cover all of your operating expenses, how much money do you have left to pay in the event that something goes wrong, right? So a 125 cover, which is a standard parameter for both banks and agency, means that you could cover your expenses and still have some excess. So in the event of occupancy, you're okay. But it's common these days that loans are DCR constrained instead of LTV constrained. LTC is another common abbreviation, right? We're always trying to understand what the cost basis is, and the better records that you take. This is generally true for everything, but if you get your expenses right from the onset, that's a big deal, because your cost basis could be called into question if you're coming in for cash out inside of 24 months. So understanding what you have into the deal is big, and it can be quite a pain to try to do retroactively. So loan to cost is your loan relative to your cost basis in the deal. That's your cost of purchase, your soft cost, your improvement cost. What do you have into it, right? So LTC is one to be familiar with. I put rate caps here because it's a common term on floating or variable rate debt, and that type of debt has many owners in trouble these days. People took advantage of floating rate, variable rate debt when rates are crazy low through the pandemic, right? They're thinking, why would I fix it? This is amazing, right? And most lenders, when offering variable rate debt, should require or offer a rate cap, which is a hedge that protects you in the event of rate increases. Now, that hedge usually doesn't go through the end of your term, and it has a cost to it, depending upon how high you let your rate go. So a lot of folks that are in hot water today, they might still have term left on their mortgage, but their rate cap's expiring. So they're at a decision point. Do I try to buy another rate cap that's expensive? Do I pay the higher debt service that I can't afford, or do I sell my property? So, I was a fixed rate guy. I'm kind of partial. I'm not a huge fan of the risk of variable rate debt. However, it can be a useful tool when paired with a good rate cap and executing a solid business plan. So I don't want to, discourage it. It can be appropriate in certain situations, but be aware of what a rate cap is and how you can get into trouble with them. If your rate cap's maturing about 6 months from now, you should be working on a solution, not hoping that it's going to get better. Hope does not help you.
Oh, it definitely doesn't.
Yeah, just to reiterate too, so if you aren't necessarily looking at becoming a general partner and buying one of these properties, but you're just looking at a deal to potentially invest in, just to get your feet wet and become a limited partner in a syndication, these are some of the questions and the things you want to pay attention to as well, because the type of debt on the syndication is really, if you find out there's bridge debt, you're going to want to know if there's rate cap. You're going to want to have someone like Adrian, where you can be asking questions and finding out, what questions should I ask in order to vet this business plan and make sure that it's not going to run into problems if the event the market shifts. So, those are good things to look at as you're evaluating deals to invest in as well.
Yeah, that's a very important subject in this environment because of the drastic increase in interest rates recently. All of those floating rate loans that were taken out in 2019, 2020, 2021, if they didn't buy rate caps, that, as you can tell in the slide, that lasts for 1 to 3 years. If you had a 5-year business plan and you bought it in 2020 and your rate cap was only a 3-year rate cap, and you have floating rate
Imagine how
bridge,
expensive that rate cap's going to be today.
that hedge is going to be very, very expensive, because it's like buying insurance. That's what a hedge is. You're buying insurance on the difference between what the debt can reach and where you need it to be. And there are billions, hundreds of billions, from what I understand, of loans that are coming due in the next 12 to 18 months that are on floating rate bridge, that have rate caps that are coming up for expiration, that there's no way they would have planned for current interest rates for bridge debt to be in the rates, in the 9 to 12 range where they are now, or wherever they end up being at the time. So it's high risk. There's big questions that need to be asked of your team when you're considering doing business with them. What is your loan to value? What is the debt service coverage ratio? What is the loan to cost all in, including your CapEx budget? And if this is floating rate bridge debt, when does your rate cap come up for expiration, and how are you budgeting for being able to afford that when it does come up? What's the plan? And if they don't have a plan, that's very risky.
Yeah.
Absolutely. Ultimately, all those terms are measures of risk, right? When you're a borrower, you want the highest of them all, right? Many, I shouldn't say you, but like generally speaking, borrowers say, I want the max leverage, max proceeds. When you push all things, it gets riskier. So, evaluating that when you're considering an opportunity is important. If all of the envelopes push, maybe it's a little bit less desirable, depending upon the business plan and upside of the deal at hand, because every deal is different.
All right. So I think we're doing a really good job of continuing to scare people about debt. Let's talk about some of the good things about debt.
Yeah, let's talk about the good options and what the pros and cons are.
Absolutely. Common executions these days, and I'm going to try to keep it very simple, is there's the bank option, which everybody knows about. And before I go into this, I want to comment on recourse versus non. Recourse is essentially a lender's ability to reclaim the collateral as well as additional assets that you have in order to make themselves whole for their lost position, right? So to say it differently, if you have all recourse debt on your portfolio and you lose one apartment and it didn't get them enough money, they will come for your other apartment or for your house or for your boat or your other investments. They're coming for you, right? That's recourse lending. And it's common. There's nothing wrong with it, but understand what it is and compare it to non-recourse lending, to me, which should be the goal, where you want to get all of your debt, type of bucket you want to get all of your debt into. So non-recourse, the obligation of the debt is satisfied 100% by the collateral. In the event of foreclosure, they only come for the asset. They cannot grab other assets from you or the sponsorship team. So I wanted to kind of set the conversation with that. What I specialize in while offering recourse options is long-term fixed rate non-recourse debt. And all of that is less risky, significantly less risky, actually, given the due diligence that we put in before lending the funds. So the bank option, I'm showing you kind of common terms, common leverage here, comparing bank to bridge to agency. Ultimately, bridge can get higher. It's a riskier mechanism as you look and compare the three, but agency can do pretty well. I think banks right now have lower leverage, lower LTVs as a function of their DCR constraints. Agency has a similar DCR to most banks. 125 is very common. Bridge money being more risky, they'll lend you at sub 1.0 cover, like you can't even cover, and they'll give you a loan, right? It's more risky, and you pay the price for that. To me, bank and bridge should be short-term mechanisms to accomplish a goal. It's not where you want to sit and camp necessarily, unless your play is a quick flip, like you're in and out, right? But a bank or a bridge loan can help you acquire a property, improve a property, get it into its operational stride, and then you come for a non-recourse option, which we'll discuss all of those options here below. Here, I'm just using the Fannie Freddie to keep it vanilla for you guys. So I try to think of it that way: bank, bridge, short duration. Bank also offers a lot of prepayment flexibility, usually. Not always read your prepayment language. But I like banks for flexibility during purchase rental plays, and also for their ability to lend on pro forma operations or as stabilized value versus agency, where we lend on in-place rents and expenses, or in-place rents with market expenses. So there's no pro forma underwriting in agency debt, but banks and bridges both will consider pro forma underwriting. So if you need an extra $100K in NOI and you're going to get it next month because you're going to sign these leases and charge $500 more per month in rent, you're not going to be able to recognize that on a non-recourse solution. They're going to lend on the in place. So it's important to understand that.
Right. So Adrian, I was going to ask you, like, when would be a situation where you would have to use bank or bridge and you couldn't do agency yet? Like, I know specifically maybe occupancy or some other things.
Great point, and we'll touch on that topic again about occupancy. The general requirement is 90% for 90 days is the general requirement. There are exceptions and rules I can work. But if you're sitting here on a deal, for example, let's say it's 90% physically occupied with 20% economic occupancy, meaning you have people living there that are not paying, well, that's not good. Or if you're just simply at 80% occupancy, physical and economic, you're also not eligible, right? So if ineligible for an agency debt solution, you're sort of forced into one of the other buckets, bank or bridge.
Right, but you can eventually make it to it. So go ahead, Lee.
Yeah, the goal is to do that analysis up front. How and when do I get to this? How do I track to it? And that's exactly what I'm doing today, is tracking it, a number of deals, waiting for performance so that I can get them to the takeout, either coming through stabilization or going through their value add business plan.
Yeah. So we've never used bridge debt before. We've only used bank as basically an option that is easy to get out of, that we work with our local lenders to be able to buy a property and hold it for either short period of time before we refinance into agency debt, or we've used agency debt. So bridge debt seems very expensive, very risky. You know, it really just doesn't feel like the type of risk or project that I would want to get involved in. You know, when would you need or choose to use bridge debt?
I try to have my folks so prepared that that's not a thing, right? But that doesn't mean that I don't get handed the ball and it's a thing. You know, their bank flopped on them, or they felt retraded. You know, basically bank couldn't control market conditions, and they need a lender, or they lose their earnest money, and they're already heavy in the deal, and you have to close. If you have to close, I can find somebody that'll close your loan. It's just going to cost you, right? Bridge advantage is it can be very quick while being very expensive. You know, there are bridge lenders who can close your loan in 15 days, right? I mean, I know some folks that you can close a loan in 24 hours. Again, this is very expensive.
That guy's name is Tony Soprano. And that's who these bridge debt lenders are, because you do not want to flop on them and they'll take your property away from you.
Oh, yeah.
Right away. Oh, yeah.
Hey, we have a quick question in the chat. Jeff and Laura Casey are wondering, is a CMBS loan one of these three options?
CMBS is similar to agency, commercial mortgage-backed security. Essentially, we offer that. We create a security, and it generally follows a 10-year duration with a yield maintenance prepayment, very similar to agency. To me, that's less common on multifamily. CMBS is something you see people placing on something that, let's say a hotel, retail. CMBS is not a big player in the multi space. Some folks use it. It's quite most people who have used it don't want to use it again. It's not very borrower friendly is the best way to put it. Not very flexible, very expensive legal. If you can get into an agency bucket, you should get into an agency bucket.
Got it.
All right, let's go to the new other fun option that everyone or that we wanted to discuss here, one of Adrian's specialties.
And I mentioned this just because everybody should be aware that it exists. This isn't your deal one type of option, but the rainbows of HUD, you know, the things that get people excited about HUD debt are the fact that there is no option that is longer term, fixed rate, fully amortizing. This has 35-year fixed rate, fully amortizing, fully assumable at rates that are superior to agency rates. In normal conditions, HUD rates are anywhere from 100 to 50 bips better than agency, and agency is normally 50 to 100 bips better than bank, right? So HUD would be the lowest rate you could possibly get fixed for 35 years, fully amortizing non-recourse. So people hear that and they're sold, right? But hold on, you know, you can't have all these good things without having.
What's the downside?
Right, you know, you do need to understand how to use the program. You do need to understand the process that it takes to get through the program, and you do need to work with somebody who has done this a lot, so that you have certainty of execution. And this is the HUD 223F. They say acquisition refi. I think I've closed 2 acquisitions in 17 years. It's truly a refinance play because of the ability to cash out at 80%. But it's a good refinance play because you can also refinance at 85%. So it offers some of the highest leverage, the longest term, and its DCR for underwriting DCR constraints is 117 versus 125. So in times like this, the lower rate, the lower DCR can yield higher proceeds along with the longer amortization period. So it can still be a tool. And I'm kind of jumping ahead here, but it makes me think of it in the fact that you're fixed for 35 years. They also have a mechanism to come back and do a streamlined rate reduction. So if you lock into a 540 rate today and you're thinking, this isn't the best, what if they're 3 again, you know? Well, you just wait until they're 3 again, and we have a streamlined process to drop your rate, leaving your principal balance intact. So there are ways that you can get into that deal and ride that deal out if you really have no intention of selling that asset, you know, because of location or whatever estate planning reason you might have. The HUD execution is a very good one for the buy long-term hold owner, but can be used by those who sell the deal because of the assumable component.
Right.
So our normal deal is a 5 to 7 year hold time frame, which we could use. From what I'm understanding, we could use HUD financing if we wanted to go through the process and the pains of doing it. Because it's assumable and we can ask for a rate reduction in the future. But I've always looked at HUD as something that we would only want to place on a property if we wanted to hold it for the rest of our lives because of the fully amortizing 35-year period. Is that that's kind of my general thought process on HUD. Would you agree with that?
It can be. I mean, I see folks who do it with a 5 or 10 year outlook just because they don't know and they like the certainty of it. I mean, you're really wrapping it up and putting a bow on it once you put the HUD loan in place.
Right.
Absolutely.
So I think, right. So I think some of the main takeaways that we've gotten so far from your presentation is that commercial properties or commercial debt on a commercial size asset of $1 million or more can come with options where they're looking at the business. All of these options are, they're looking at you, but they're also looking at the business plan itself. And you really have to have a debt strategy as part of your business plan. And I want to also mention that, hey, having assumable debt that's fixed rate at a low interest rate can add so much value to a property of that size as well, especially in an interest rate environment like today. Like someone who placed debt a couple of years ago at a significantly less lower interest rate, if they've got a decent amount of time and a decent amount of coverage left on their loan, like that's a valuable thing in today's marketplace. So I'll let you touch on that a little bit more, Adrian.
Yeah, I mean, it's a great point. And that's actually, I support our regional sales teams, our guys that sell multi. And that's really what's trading today is people who have that debt in place Maybe they let their first 3 years of IO burn off. They've got a year or two left of IO. They still have plenty of leverage on the deal, and they have a below market rate. Well, what that is that's a premium, right? Like, I'm going to sell this to you for a premium because my in-place revenue is there, my value is proven, and I'm getting you debt that you can't get in the open market, right? So that, you know, that's ability to assume is critical whenever you're doing something long-term, and generally all long-term fixed rate non-recourse options offer some way to assume that debt.
Absolutely. And Adrian actually helped us place a 10-year loan on an asset in the latter part of 2020 that's fixed for 10 years at 3.48%. And I mean, on the prior side, we were looking in the current rate on that same loan today would be in the very high fives. I'm talking, you know, a minimum of almost double, probably 250 basis points or bips, or 2.5% more than what we pay. So on $1 million, we pay $35,000 a year in interest. Well, that guy who would be placing the same debt on the same property today would be paying $55,000 or even close to $60,000 a year in debt expense on that same asset. So that asset, just the debt alone, makes it more valuable to us and a future potential buyer. But let's talk about the HUD 221D4 program.
And this is, again, you guys aware what it is if you ever hear it, and just be aware that it exists. But the HUD does offer a new construction or a sub-rehab program. This is generally suitable for loan amounts in excess of 10 million. You wouldn't go through the effort and the cost for something less, because the costs are the costs. So if it's a $2 million deal, it's going to feel a lot heavier than if it's a $20 million deal. But you should be aware that there is an option to have a construction and perm all in one loan, in your construction period up to 36 months of interest only, and it converts based upon the rate you lock the time of construction commencement. It converts to perm. So it's an all-in-one solution to develop or do a substantial rehabilitation on a multifamily project. But when it converts to perm, you're on 40-year fixed, fully amortizing terms, right? And the rate's better than the market rate that the banks or agency offers. And the DCR is 117, right? And you can do the deal with only 15% in. So these things that make it easier for a developer to do a bigger deal, that's when you use a D4. When you bid off, you have a good opportunity, and maybe you need to stretch a little bit. The D4 can help you do that with that longer amort, lower DCR, and higher LTC or cost constraints.
So this is a 40-year amortizing, fully amortizing loan. If you go out and build a brand new apartment complex and you want to keep it for the rest of your life, the rest of my life, I'll be 80 by the time this loan would mature, almost 80, 79. I want to date myself too much. But you build an apartment complex, you put 40-year debt on it, you write it all the way down to zero. I mean, and you're at the lowest interest rate possible, and you originally built it and you only had to put 10% down to build that. I mean, it's a developer's dream.
Gosh. So the reasons that's so attractive, right, is because 40 years from now, like, how much is your property appreciating, and where are interest rates, and how much debt do you have left on that? Like, all of these things we really love about real estate. Like, oh my gosh.
Yeah. And I go back to the streamline rate reduction here too, right? Let's say I lock somebody today at a 540, 550 rate for the 40 years, and all of a sudden we hit another good period of rate decline. They can take advantage of that, right? So, it's not so inflexible that you're stuck in this for the life of the loan. There are very simple, easy options to drop your rate on it too, while keeping the debt intact and not going through a big process.
Hey, another question real quick, and something to touch on as well. As we see FHA and HUD, we're talking government. And so we had a question about permit checks. Maybe talk a little bit about the strings attached with government financing.
What do you mean by permit checks?
I mean, I'm assuming you're talking about, doing checks on the construction process, making sure things are done with permits, making sure things are done with,
Yeah, I can really go down a rabbit hole here with this one, but I'll try to keep it simple. Absolutely. It's fully bonded and insured. The construction contract is final when we submit for the cost, the AEC, architectural engineering cost review. This is a very scrutinized type of thing, right? So yeah, there are ongoing inspections throughout construction. There's a construction inspection fee. There's somebody there kind of all the time. If somebody really is interested in doing this D4, I'd love to run you through a live example and connect after this. But because it's somewhat specialized for those who develop, I'd say hit me offline and I'll roll through real life examples that I've got done and in process.
great, thank you. All right.
All right. Non-recourse debt options.
So we covered a lot of the pros already, just in talking about the program overviews. One that I like to point out is that the likelihood of default. I mean, if I'm an investor and I hear that my sponsor is using HUD debt, I have I'd say extra peace of mind because I know the level of scrutiny that goes through in terms of understanding the asset, the market, and the long-term viability of the deal. And so if somebody can get HUD debt through either of the programs just mentioned, I feel that much better putting my money in it because I know that we will outperform what was underwritten. There's less than, I say 1% here, but it's less than 0.5% default risk on HUD loans because of the intensive underwriting process. So, the con is there's an intensive underwriting process and it takes 4 to 6 months to do a refi, 10 to 12 months to do a development deal. But the pro is this scrutiny means this thing should not fail, or the probability of failure is less than 1%. Yeah, I can't say nothing's impossible, right? But I like that as a pro. We touched on the other ones, but I do want to point out some of the downsides to HUD, some things that people should be aware of. It is that long processing time frame, making it not a great acquisition tool at all. The loan fees are more expensive, depending upon the size of the loan, it can feel like 3 to 6% instead of 1 to 2%. Something that somebody feels more palatable. I would argue though that you're getting 3 loans in one compared to 3 10-year deals, or even more when you compare it to 10 3-year deals. So HUD's bringing quite a bit for the cost. There are annual audits required. That's something that's an ongoing cost, and it's a process to prepare for an audit. So I just like to make sure, and I do this in great detail by going through the regulatory agreement with somebody before they actually ever are given an engagement letter. But being aware of that annual audit requirement's a thing. As an investor, I sort of like that there's an audit going on and there's that oversight of financials and accounting though. So I can see how if I'm investing in that and I know that they're getting audited, I kind of feel better. Replacement reserves are required, and that's not uncommon for any non-recourse execution. For those of you not familiar, they set up a CapEx fund. It's held in a separate account. You can sort of choose where that is held, and it's used to fund your future CapEx needs because of the long-term nature of the debt. But you have to fund into that, and that's a determined amount based upon the condition of the property, basically. HUD also constrains your distributions to semi-annual or quarterly, depending upon how you report your financials to servicer. So you cannot, let's say you had monthly distributions to investors, right? This is not friendly for that. So that's something to think about, is that in order to distribute cash to yourself or investors, you must complete a surplus cash calculation, submit it to servicing, have their approval. They don't actually control the account, but you have to get approval to release the funds. So it is that oversight that some people who are used to walking to the bank and high-fiving and walking out with $5 million. This is a lot different than that.
Right.
Security deposits must be fully funded and maintained in a separate account. For some people, that's standard business practice. I like to think for others, I've seen people get up in arms about security deposits being funded so that they're available for refund. But that's a thing in most non-recourse. HUD makes it very specific that they require the account being established and that servicer knows where it is.
Who
There
would
are
have
also
thought?
what's that?
I was going to say, who would have thought that a question you should ask a potential investment is, do you actually save your security deposits for your tenants?
I remember being surprised the first time I heard of it, and then I heard of it more and more. So it's shockingly not all that uncommon. The annual physical inspections, most non-recourse options do have an annual physical inspection. HUD calls theirs REACT. What they're looking at initially is life safety issues, broken GFCI outlets, damaged smoke detectors or missing smoke detectors, trip hazards, loose railings, that kind of thing, or blatant deferred maintenance. Those occur annually unless you score very well, in which case they occur biennially or every other year.
Sweet deal.
Now it's something that's more straightforward, and I think that's kind of good, a great tool that Lee, Meagan are already using, maybe others are using too. Fannie Mae, just giving you an overview. And I'm trying to go off to too many rabbit holes because you could really talk about debt for a long time. But
Adrian, are you on the next slide, right?
Yes.
Here we go. Boom.
So Fannie Mae conventional versus Fannie Mae SBL, small balance loan, which I'll get into on the next slide. We call it conventional because it's essentially targeting those loans in excess of $5 million. So that's an important qualifying line to determine which bucket you fall into. Agency debt offers a variety of fixed rate terms, 5, 7, 10 being most common, and they all come with a 30-year amortization. Oftentimes these days, if its size is right, and is delegated to us as lender, we're offering full term interest only. And we have an example later where I'll illustrate that, but you're fixed for 10 years, it's fully amortizing. So a great win for your cash flow and distributions, right? It's really used for acquisition or refinance deals. You can have some level of CapEx in a Fannie deal, absolutely, if the DCR can afford it, I'll say, right? If you're within the constraints, but you can certainly fund repairs in normal conditions within the Fannie Mae loan. Prepayment on this is probably the thing to pay attention mostly to, right? It's yield maintenance. Yield maintenance is a head scratcher. There's not a simple way to determine what yield maintenance is because it depends upon the interest rate in place on the deal, plus the interest rate at the time of prepayment. But what you're essentially doing is making the lender or the note holder, right, because we securitize these things, whole for their lost interest payments. As interest rates go up compared to your note rate, yield maintenance becomes less expensive to prepay. Same thing as your loan terms out, your yield maintenance prepays lower. But as the rate goes up, think about it, that lender, that capital source can now put their money to work at 8% instead of 6%. But when rates go down, yield maintenance is very expensive, right? Because they wanted their 6% for 10 years. And now rates are 4%. So you're not going to repay that loan, right? But understanding what yield maintenance is important. And understanding that it gives you the best price on your agency loan is important. There are all sorts of bells and whistles in agency debt, right? You can define prepayment structure, but everything has a cost to it, right? So on an example I was running with Lee lately, he said, show me the structure. And I showed him the deal and it had a 70 BIP adder for a defined prepayment structure. He said, well, I'll take a 5-year deal, right? Pivot off of that into something that fits your hold parameters. So just understanding that agency debt's not that flexible, but again, it's fully assumable.
So yield maintenance is basically the bank's way of making sure that if you sell early, they're going to at least get a certain amount of profit that they were hoping for. And if interest rates go up, then the banks would rather put that money into some new asset that they can get higher interest rates on. So then you can pay less yield maintenance. But if rates go down, then they're like, we really want you to stay in your loan and we're going to make you pay more to get out of it.
That's right. So much that you would not do it, right?
Right. You're like, someone buy my loan. Assume it.
That's it. But then nobody wants to assume it because the rate's above the market.
Exactly.
Rate. Why would I take your 6? The rates are at 4, right? So that's when yield maintenance can become a little
Problem.
cumbersome.
Yep, makes sense. So, real quick, Adrian, I see you have, I know you've got a few things that, rate lock, occupancy, but supplemental. What exactly is a supplemental loan?
So that's agency speak for a second, essentially, right? So it is permissible on Fannie versus Freddie. That's why I like the Fannie example to do a supplemental. So let's say you add equity. Let's say you purchased with a 7-year structure and you've added your equity by year 2, and you want your equity back out. You could take a supplemental if the operations are there, the value is there, and take advantage of getting some cash back out of the deal. So that's what the supplemental helps you acquire is a little bit of flexibility on your debt terms to lever up as you perform. And I should point out that it's coterminous with your first loan. And it's usually, I can't use the term always, has a higher interest rate than the first. That's a very, the most common way is it's a little bit more costly, subject to the current market conditions for the second, and it's coterminous with your first.
Right. So if you're thinking about an apartment complex, like a single family house, like a burr, right? So you're buying it hopefully at a cheap price or the right price, and then you're placing that debt at purchase. But then you execute your business plan, you raise the value, instead of having to completely refinance that entire loan and be exposed to the new market interest rate, you can just add an additional loan that pulls from the equity that you gained. That's in addition to your original debt.
That's right. So, I mean, think about somebody who placed debt 2021, right? And we had, I'd say broadly, most markets had significant rent appreciation. Their value's up. They weren't even thinking about doing a supplemental, but now they've got all this equity on the table, right? So they're going to say, well, I've got a 348 rate, right?
I got one of those.
I don't want to mess that up, right? Because I'm still in my IO period. But I do want this extra money I have because I want to buy some more stuff. Okay, let's do a supplemental, right? And now you have this little strip that's less than the bigger chunk at that higher rate.
Which is exactly how we structured the deal that we bought in 2020. We have a couple of the investors that were on that project here in the room right now. We are nearly through the process of executing our value add business plan. And then we will return back to Adrian and say, hey, Adrian, ring the bell. It's time to add our supplemental loan to the deal. We've increased the value of the asset by executing our value add business plan. And we'll use that money to return capital back to our investors. And then they can take that capital in a non-taxable event and reinvest it into other assets while we keep the property. That's the beauty of that particular structure. It's not how we structure every single deal, but I'm really excited about the fact that we chose to do that on that one particular project, the Park Hills portfolio. And we used exactly this type of loan on that project, that 3.48% fixed for 10 years. And we're only 2.5 years into that project, and we're not even 2 full years yet. Actually, we're excited to add that refi onto it.
This next option is, and I'm using Freddie Mac here because of a key point I'll point out, but both Freddie and Fannie offer small balance loan solutions. They developed it to be a streamlined process, lower legal costs, lower third-party reports, simpler process overall. And it's appropriate for loans in a $1 to $7.5 million range. So sometimes there can be overlap, and when there is, I price it both ways: big balance and conventional, small balance and conventional. But oftentimes with investor groups, this is their first foray into the world of non-recourse. They get their feet wet with the SBL because it's a $4 million deal, and there are partners splitting that up, right? So I use the Freddie Mac example because I really like the fact, especially in today's environment, that your rate is secured or honored. It's not formally locked, but it's secured or honored when you sign your term sheet and wire over your initial fee for third parties and retention. Right then, you've taken your rate risk off the table. you don't enter into a process, the market turns on you, and then what do you do, right? So I really like the Freddie SBL program for that reason. It helps you get deals done in a rising rate environment, and it has good discounts available as well for some deals that are more workforce housing oriented, right? That we call that mission rich, and gives you better pricing. And I tend to run into maybe some C properties when I'm in this sort of loan range. It depends on the market, right? But this is a great solution and a tool. It has all the same. It has all very similar bells and whistles to the conventional Fannie deal in terms of 5, 7, and 10 being common, interest only being available, 30-year amortization. Many of the things are the same. Yield maintenance is the prepayment, 90 for 90 is the occupancy requirement, similar net worth and liquidity requirements that I mentioned above, and experience requirements as well. So the main thing about this to be aware of is that there are long-term fixed rate non-recourse debt options for loans in the 1 to 7.5 million range, as long as it's stabilized, right? So this is a great way to kind of get your feet wet, if you will, as you grow into bigger deals. It's a common entry level agency deal.
Yeah, I see on there, you can have as little as a 5-unit property with that. So yeah, definitely. This is like step number 1 into commercial, dipping your toe in here.
And 5 units at $1 million, like San Diego,
yeah, easy.
That's
I've got a 6-unit deal and it's $2 million. Like, what is going on?
Oh.
California.
Don't have that in St. Louis.
Definitely not. Definitely don't have that in St. Louis. I thought we'd be getting a lot for $2 million in St. Louis.
Oh yeah, no, 40 units.
Certainly seen it before, and it's just the way that it goes sometimes. So yeah, it can't afford lower unit counts, right? If the value's above $1 million, right? So not that crazy depending upon your market area. I'm
All right.
Yeah, similar timeline too. 60 days to me is kind of normal. Sometimes you can go fast and be done. If everybody flows quick, 45 days. Sometimes it can take 75 days if people move slowly. I say 60 days on average.
Yeah.
Great acquisition tool.
Right. Pros and cons of agency debt.
First, I mean, non-recourse is the recurring theme here. That's where you want to get everything to. So all of the options discussed are non-recourse. The fixed rate term is generally longer than what banks would ever offer. And the amortization certainly is longer. Most banks don't offer 30-year amorts, and especially when they start to get skittish as they are today, they have rates that are superior to any bank rate out there. Generally speaking, I mean, everybody can pull out an exception for some high net worth individual that got a sweetheart deal. Generally, better rates than conventional bank debt. It is, again, fully assumable. The IO options that you have are there as well. The ability to do early rate lock. That's one thing about Fannie that I really like, or even Freddie on signing Freddie SBL on signing your term sheet. You're sort of, even though you don't recognize it with your bank, you're sort of floating. They don't know what that rate is. They're going to try to honor it, but if things turn on them, as I've seen happen quite a bit in the past 18 months, buyer banked on one thing and it's another. Well, I can avoid that. I can mitigate that risk by securing my rate early. I think that's an important one to point out. And also the level of interest only that you get. Most agency options offer more interest only than a bank ever would. I don't know many banks that would ever give you 10-year IO, right?
Heck no.
The downsides really are the flexibility. The fact that yield maintenance gives you the best rate price. You have to pick a term that's appropriate for your investment period, right? 5, 7, 10, or there are different iterations, but if you think you only want to be in it for 5 years, don't take a 10-year deal just because the price is better, right?
Absolutely.
Unless
especially if you've got the yield maintenance.
Yeah. Unless folks are willing to come along for the ride, right? I would say that all of these options have generally higher costs than what I would call standard bank debt does. The third parties are more, the legals more. And so if a bank loan costs you 1 point, let's say an agency loan costs you 2. And I'm being a little general there, but it does have a greater cost, but you're also getting quite a bit more, I'll say, safety and benefit. They also have those annual inspections, right, that most banks don't require, and funding CapEx or funding replacement reserves through the loan period is common. The number one con really is that final bullet point there that I pointed out before. In place cash flows are required by all non-recourse lenders, whereas pro forma lending can be common by bank or bridge. So, agency is really ideal for stabilized assets. Even if there's upside, agency can still be a great option, and I do the compare and contrast daily. It all depends on the deal, right?
Mm-hmm.
Oh, absolutely. And turning to someone like Adrian for advice on, what debt type is going to be right for your business plan is going to be essential in your process of underwriting the asset and knowing what type of debt you should be plugging in and what type of debt fits your business plan. Because next thing you know, you got a 10-year loan on a 5-year deal with yield maintenance, and you've got a $500,000 or $1 million prepay that you didn't plan for. Oops, that'd be a pretty bad day.
Yeah.
I wanted to make sure that I outlined, how do you qualify for these? As we talked about PFS or personal financial statement earlier, I touched on a couple of them, but generally the investor or the sponsor or the aggregate sponsorship team needs to have net worth equal or greater than their loan amount. If it's greater, it's great, right? Right. That's more strength that lets me use that as ammunition to push agency to lean in. We can go back and tout the strength, and they can lean in on their grid pricing for us. Same thing with liquidity. The general rule of thumb is you need to have 10% of the loan amount liquid post closing. So your down payment, if you will, can't wipe out. You could say, yeah, I need $2 million. I have $2 million, but $2 million is my down payment. Not going to work. You need to have 10% of the loan amount left in post closing liquidity. And same point, the greater that you have, I've talked to groups that say, well, you're good with Bob's. You don't need Mary's. And I'll say, well, Mary happens to be pretty strong. Send that out over and let me slap 20 million on top of my net worth and 2 million on top of my liquidity, right? It helps my case. So giving your lender the tools to argue and advocate for you. And at the same time, I put this note in here. Everybody's good at something different. So if you're very good at sourcing deals and beating the bushes, there are ways to solve for the puzzle, right? We're always trying to work this puzzle when we're doing real estate deals. The answer is, to me, always trying to make a deal get done is find people to solve for your piece of the puzzle, right? Like, don't think a deal's out of reach. If you have an inside track to a seller who's 82 with some deferred maintenance, it was built in 1985, and this person just wants to get rid of it. Well, that's a great lead. I would like to help you find partners for that.
Right. And that's such a huge point. Like, multifamily real estate at this level is a team sport. Like, it is a team sport. You're not going to go, if you're used to owning 100% of everything, you're also taking on 100% of the risk. So, that's how Lee and I got started. Lee was a prior broker with Marcus and Millichap. Like, he was really good at underwriting and finding deals and having those conversations with brokers and owners. And we got really good at sourcing deals. And now, we've grown into having a great team of people who fill the gaps and just make our overall lendability stronger, but also just make our business plan more solid as well.
Oh, yeah.
That's perfect. I just don't want anybody thinking that if they find a good opportunity that there's no way they can get it done because of what I just said above. There's always a way if you're willing to talk about it and willing to collaborate and work things out.
Who, not how.
That's right.
Not how.
They're also not just, I want to hit on those experience requirements real quick. You also need to have a level of experience. If you've never owned, managed, invested in a multifamily asset, they're not going to let you. The general requirements are that you need to have had one or more multifamily property of similar size and scope for a period of 2 years, or you could just have one for a period of 5 years and qualify. They want to know that you know what you're doing and that you can make the right decisions, like firing a management agent or, you know, shopping for insurance, making good business decisions, right? So this does have a level of experience required. And that's another thing too, that you can partner with and for to get somebody on your team to solve for that piece of the puzzle. I work with first-time agency and HUD borrowers all the time, and you know my job is to show them the path on how to get qualified and coach them through loan approval. Right. Also, they're going to look at the management company and they want to understand who's going to run the asset, how many units do they have in the market, how long have they been in business, because if a lot of times you could have an out-of-state owner and they say, oh well, I have a person there on payroll, and this isn't going to be good enough, right? They're going to want to know that you have a qualified third-party manager in place who has experience running units in the market area. It's a big deal. So just want to point out those experience requirements so that it's food for thought.
So anybody who is a novice or a beginner and looking to be able to grow larger, and I actually remember this conversation that I had with Adrian, one of the very first times I ever met him, was about this experience requirement. I came to Adrian and I had something along the lines of $500,000 in liquidity, but I had no experience of owning an asset. So what did I need? I needed a partner with a higher net worth than I did. And that gave me the ability to take out a bank loan to go buy a property. But then when I wanted to go bigger and do agency debt projects, I went back to Adrian and I said, Adrian, what do I need? And Adrian said, well, now you need a partner who has agency experience. So then with my liquidity and a good property and their experience, we can go buy an amazing asset and put agency debt on it. And guess where the next stage and the next level will end up being for our journey? HUD debt. Now we're going to end up going after the HUD debt with the fully amortizing over 35 years. And then after that, what do we go do? 40-year fully amortizing development loan projects. That's the ultimate goal. I want to be a developer one day. One day I'm going to develop property, own it for the rest of my life, give it to my kids, and it'll be fully paid off 40 years, a 40-year amortization. All because I met Adrian through a good friend of mine back several years ago. And now I have the agency, chip on my shoulder or whatever it is. So I can bring that to any one of our team members who have a deal but don't have the experience.
Hey, real quick. I'm sorry. We have a question. Sam Passanisi's got his hand up. Sam, you want to unmute and ask your question?
Thank you very much, Megan and Lee, for having us today. Adrian, you and I talked 1 or 2 weeks ago, and you had mentioned, and by the way, thanks for presenting today, because I've learned a lot so far. On an agency loan, if the group has experience with agency loans in the past, but does not have the net worth, let's say we want to do a $50 million deal or a $45 million deal, and we don't have the net worth, do we still qualify because we've had the experience, we've done a couple of deals? How does that work? Let's say it's a bigger deal.
Having the experience helps, and there's a level of net worth that as you get in $50 and $100 million, which we see, right? You don't necessarily need to have 50 million in net worth. The liquidity is still a thing though, right? That becomes the sort of the stumbling block there. All that experience is transferable, right? So like as you partner in a deal and you ride along on that investment and you're participating, you as you go through the key principal credit screening become agency approved, right? Those are stripes that you maintain. They know who you are. You've been approved. Very valuable stuff there. And having the more experience like that you have, the easier it is to say yes to you, right? So I think it's hard for any sponsor to walk in the door and do a $50 million deal for their first deal, completely unknown to the agency, right? So having some prior experience with them would seem natural in terms of growth, right? Like, but I think maybe I'm not answering your question. The answer is yes, having the prior experience helps. No, you don't necessarily need to have 50 million in net worth to do a $50 million deal, as long as you have the appropriate liquidity post-close.
So let's say we've got two $25 million deals going at the same time. So we'd have to have probably 5 million in liquidity, and the partners all had agency experience.
If they were 225s, I would go on the rule that I only need to have 2.5.
Oh,
I'm separating those up, and I've actually done that
I
before.
see.
I'll chop them up. You know, I'll say, don't you have 2 phases because you don't meet net worth and liquidity? Can we do this in 2 phases and then break it down that way?
Oh, all right, fine. That's good to know.
Yeah.
Thank you very much. I appreciate that.
You got to get creative, right?
Love it.
All right, so I'm really excited to be able, we're an hour and 20 minutes into this. I'm really grateful for Adrian's time that he's been so willing to give to us this evening, and everybody who is still with us. So let's run through a quick soft quote example of what a quote looks like from a loan, and then we'll run through a couple slides and contact information and part ways with everybody for the evening. But yeah, go ahead, Adrian.
Thanks. I just wanted to show everybody what a soft quote looks like. Soft quote just means preliminary analysis yet to be presented to the agency for final pricing approval. But this is what we come out with after we collect the basics, right? You know, the T12, the OM, the rent roll. We come out with a soft quote of I'll say standard options, whereby we want to lay it on the table and say, this is how it looks if you pick different things. And so that's what this is here. You know, starting in the far left upper hand corner there, it says product agency 5 over 4.5. That means 5-year fixed rate, 4.5 years of yield maintenance, and then the same logic applied down. You see the 65% on line 2. That means that that loan is at the 65% pricing threshold on a 5-year fixed rate deal. And as you go over, you can see the interest rate is improved as a result of the lower leverage. Us agreeing to lower leverage, we can get a better rate. So that, you know, this is what I'm trying to illustrate to buyer, right? Is there's an option here to get a better rate if you don't like 6%. Although it comes with a premium cut because we're at 65% of purchase price or value. But these are very common loan terms, 5s, 7s, and 10s. And normally the short duration is not more expensive than the 10-year. Everybody knows we're in a weird time. So, you know, 10-year price is the best today and gives you the highest level of proceeds. But if you only want to be in the deal for 5-year, you need to think about those couple of options. So this interest rate reflects the build up of the rate, which is a function of the spread. The investor spread is what that column means over there, plus the index, the 5-year, the 7-year, the 10-year treasury. Debt yield's a lending metric, doesn't mean much to investors. It's loan amount over NOI. So this means more to lending folks than it does to individuals. But this column here, LTV and DSCR constraint. A lot of times the first thing folks will say is, I'm not at 80% of my purchase price. And it's because we're the lesser of 80% of purchase price / value or a 125 cover. So, you know, what I'm doing there with that column is trying to explain to you what tier pricing level we're at, understanding that the highest leverage has a higher price. And if you come down in leverage, like to 65, you get a better price. I'm just trying to illustrate that to folks at the initial explanation. Then they give me feedback and I tweak it to be what they need it to be. In this example, and this is a real life example, right? This is a real case. We could offer full term interest only. So there's big appeal there. Everybody knows what bank rates are. Our interest rates are far superior to what the bank can do. And then we show you the prepayment terms, which sort of transfers back to the column 1, you know, 4.5 equals 4.5 years of yield maintenance. We put in notes here some things to consider, you know, sort of disclaimers, which are standard, as well as the indexes and the date of the quote. But down below, it's helpful to understand what a lender looks at. We look at a T12, we look at a T3, we look at the current rent roll. And the lender pro forma column, the revenue that we're underwriting to is really based upon the current rent roll. We lean on what's in place. Whereas the borrower budget is going to be much better in short order. We can't lean on that because 1.7 has never been achieved. I can lean on 1.4 million though, because it was achieved in the T3, it's achieved on the current rent roll, and I'm permitted to underwrite at that level. So that's how we get our underwritten income. On management fee, we will lean on borrower budget for known costs like management fee, payroll, staffing, and insurance. There are certain costs that are known, and there are certain costs that are not, and that are historically proven, like utilities, right? Advertising. And in the case of a purchase, when you're changing owners, we would look at market comps as well. So we give some attention to borrower budget. We put a lot of focus on market comps for support as well. So just trying to show you how we look at things in terms of the historical look back, the period that we focus on, and reliance on borrower budget. That's the soft quote in a nutshell, guys.
A lot. Well, while we still have Adrian, we have it, and while we're looking at this soft quote example, does anybody have any quick questions for Adrian? This is something that is actually a deal that we worked on together. And, I really appreciate all of Adrian's insight that he was able to give to us during the process of placing or attempting to place the loan on a project that didn't end up working out for us. But yeah, before we skip past out of the soft quote, any questions about how the soft quote is built, structured, or any of the terms in there? I don't see any hands or notes in the chat, so all right.
Give them a chance to type. Give them a chance to type. Yeah.
Oh, sorry. Yeah. D.
How long does it take to put together a soft quote?
24 hours.
24 hours.
There we go.
I can do it in less, but I like to provide a window. If you send it to me in the morning, oftentimes I'll have it back to you by close of business. But I like to say 24 hours.
That's awesome.
With your underwriting, need to be able to provide the underwriting and the income and expenses in place.
Right. Yes.
The normal stuff.
Must have some input.
Yeah.
Awesome.
I have a tool actually I can do on, because some people say, I don't have that yet. Just tell me what the number is. Or like, I have a tool that I can tell them the number with the disclaimer that this is less reliable, absent having seen anything other than your verbal indication, right? Like, but I do have I can give an answer, because the question is always, what's the rate today? And the answer is, it depends upon, is it a 5, 7, a 10? I mean, there's so many bells and whistles, right? But I can spit something out quickly if that's the demand.
Hey, I've seen Adrian pull rabbits out of crazy looking hats before.
Nice.
Adrian
well,
Hartman,
so
everyone.
Much.
And and we'll share, make sure actually put your contact information in the chat while we're finishing through our quick slides here that we'd like to go through as well. So then everyone has the opportunity to be able to reach out and connect with Adrian, create the relationship ahead of time. If you don't have a PFS already established, you need to get your PFS. Or if you don't know where you can get one, email Adrian and he will send you one, and you fill that out and you start that conversation now, because before you find your deal, just like when you're buying a house, the first step in buying a house is getting pre-approved in order to figure out what kind of house you can shop for. Or in my case, when I was getting pre-approved, Adrian was telling me what kind of partner I needed to go find based upon the type of asset I wanted to go buy. It was, I want to buy this kind of asset. He's like, great, you need to go find this kind of partner. So then that's what I did in order to go find my partner to close on my next deal with thereafter.
Yeah.
So, and
that pre-approval too, like you'll use that pre-approval when you're submitting LOIs, and it's something you're going to need.
We used it today. Adrian provided us with a pre-qualification letter for Green Forest Capital on a deal that we made an offer on today. And it is something invaluable in that process that the brokers, the owners, everybody wants to see that you are vetted, that you have your stuff together, that somebody already knows that you can qualify for the debt required to buy the property. Because I'll tell you, nobody uses cash to buy deals, and if they did, they'd ask you for that bank statement. So, what do we do? What would you do if you had, 50,000 and you wanted to invest it in real estate? Well, we're here to teach you that bigger is better. It's better to have a grape. Have a slice of a watermelon as opposed to a grape. So that's what you can do when you invest in a multifamily syndication. That's what Green Forest Capital does. We share in the ownership of a multifamily real estate asset. Go ahead.
Right. So if you attended last month's webinar, you know that we talked about like, hey, single family house versus investing in a syndication. Which should I do with my $50,000? Well, one of the reasons we love syndications, like Adrian just talked about, is that, hey, even though you might not qualify to sign on agency debt financing or have any real estate experience at all, like you can invest in a deal with a strategic business plan that's been vetted by a person like Adrian, that has a qualified sponsor on the team who has multifamily experience and net worth to show for it. Like there's so many things that you can, that really make syndications appealing and opposed to buying a house with $50,000 where you take on all the debt risk, all the maintenance risk, and now you have to learn how to become a landlord.
And it's passive.
That's right. 100% passive.
So how do syndications work? So you have the property at the top. You have an entity that owns that property, and then that property is co-owned by two different additional entities. You have the Class A members, the limited partners who fund a large portion of the acquisition of the deal, and then you have the manager, the general partners, who run the deal, take on the risk, sign on the loan, execute the business plan for the passive partners. Then, there are different wonderful benefits to being a passive limited partner. You receive cash flow, you participate in appreciation, you get tax advantages and savings on your income taxes, and you get to keep focusing on what you do best by being focused on the thing that you do, and let the people who do what they do best, us, focus on the asset. So there's two different types of investors that can invest in two different types of syndications. We have 506B syndications, 506C syndications, accredited investors and non-accredited investors. Non-accredited investors are required to only invest in 506B syndications. We have a structure that allows you to be able to do both. So if you're non-accredited, and if you have an established relationship, or you're accredited, and if you don't have an established relationship, our objective is to establish that relationship ahead of time. So not an accredited investor. Sorry, go ahead.
Oh, I was going to say, what we're trying to say here is that whether you're accredited or not, you can still invest in a syndication depending on how we have it structured. But we have it structured to where both types of investors can invest in syndication. But the most important thing is that we have a pre-existing relationship with you, is that we have met you before and talked to you about your investment goals.
And then we can bring you those opportunities before we're even allowed to bring them to the public, and then limit the opportunity to only fully accredited investors. And how do you do that? How do you establish that pre-existing relationship? You get in touch, you scan that QR code, it will take you to the Calendly link to book a 15-minute call with me to be able to discuss your potential opportunity to be able to invest passively in our next syndication that we are working on actively every day, building that pipeline of a new opportunity. So if we haven't established that relationship yet, take a moment, scan the QR code, book a 15-minute call with me. Be happy to discuss our investment criteria and what types of deals we look for, and make sure that we're a good fit. And then we'll do 2 more additional phone calls that take about 15, 20 minutes thereafter. And then after that, we have an established relationship. So contact information in the slide, QR code for you to be able to make it easy on you. And that will be a wrap.
Look forward. Yeah. we look forward to meeting you.
Yeah, I look forward to meeting each and every one of our investors with Green Forest Capital. They have my phone number. I have theirs, my personal cell phone. Like they have my personal cell phone, every single one of the investors that we do business with. And I want to give a big round of applause for Adrian Hartman for his amazing presentation on debt. It is not the most exciting thing. It ain't baseball, but it's really, really, really important. It's probably the most important thing when it comes to real estate investing is the ability to utilize leverage and making sure that you don't it up.
And it's more exciting than insurance. Hands down.
Yeah, we're doing another show on insurance later, but we're going to have a fun one in between that. So Adrian,
awesome.
And
thank you, Adrian.
Thank you guys. Thanks to everyone who attended, and please really reach out to me. I'm trying to talk to folks like you every day. So happy to connect and start to build a relationship.
Absolutely. And for those who have asked to, if you want to watch or keep a record of this webinar for your review, or just to touch base on it and learn something again, get that contact information. We are going to post this on our YouTube channel. We have the YouTube channel dropped in the link. Please subscribe, or in the chat. Please subscribe, and then you'll always be able to see the recordings of this and our tours and pours events and other events that we have throughout the month for Make It Happen Multifamily and other deals that we do.
Make It Happen Multifamily YouTube channel is growing. Like, subscribe. You'll get notifications of our events, our live events, as well as our recordings of these webinars and some shorts and quick tips. It is the interactive platform for you to be able to learn more about real estate while literally just sitting on your phone wherever you happen to be watching YouTube. So I really, really want to say thanks again, lastly, to Adrian and everybody who's still in the room, and to all of the